everyone. I'm Gene Massey, the CEO of MediaShares. This is a MediaShares DealMaker webinar on crowdfunding Reg A with a syndicate of brokers. And we've got a very stellar group today. Some people that are pioneers and legends in the industry, and they're going to answer some questions and tell you all about what we're talking about, this syndicate of brokers. So I'm going to turn it over and let everybody introduce themselves. Matt, you want to start?
Thanks, Gene. Hi, everyone. Matt Goldstein. I'm one of the co-founders of the DealMaker group of companies. DealMaker came to market really as a technology company. Sometimes we say we're in the community building business. What we do is provide a suite of tools to allow brands to turn their communities into a source of capital. And what that means is, to give a few examples, we did the Green Bay Packers common stock offering in 2021. So that's a community of hundreds of thousands of fans, all of whom wanted to buy shares in what was effectively a private placement. And using our platform, they can buy shares of something they believe in as easily as buying shoes from a Amazon website. So you'll hear myself and John, my colleague, talk sometimes about turning capital raising into e-commerce, and really applying the logic of the online medium of exchange and medium of communication to the raising of capital. Every brand out there has an Instagram following, or it has a newsletter with hundreds of thousands of stakeholders. And that's a community that could be a source of capital. And so the DealMaker group of companies, we own a broker-dealer, we own a transfer agent, we have a marketing agency, we have a full-stack payment processor. The mission for all of us is to help brands turn their communities into a source of capital.
And John, do you want to say a little bit what you do?
Certainly, yeah, and thank you for hosting us, Gene. It's a good segue into DealMaker Reach because we are the marketing agency at DealMaker. So what we think about is how to supercharge some of these campaigns with the digital storytelling assets, right? To Matt's analogy about e-commerce, we are building the storefront where DealMaker's technology is the back end, for this storefront, so people can buy shares online in just a handful of minutes. So we supercharge the campaigns, creating those assets, whether it's video, website, ads to drive traffic there, or helping to communicate to their existing community. How do we do that through email, SMS, webinars, et cetera, to power some of these campaigns and help drive capital through the pipes and services that DealMaker offers.
And Mark?
Thank you, Gene, for having me. I'm Mark Alenowitz, and I am currently with Digital Offering and a company called Cambria Capital. And I created the methodology for a lot about what we're going to be talking about here today, where back in 2015, actually all the way back to 2012, when Jobs Act first came out, Gene and I actually sat on panels together and were instrumental in helping create the framework for where we are today. And we had designed the methodology for Reg A to look, act, and feel like a more traditional IPO, and did the first IPO onto the New York Stock Exchange. In fact, the only two onto the New York Stock Exchange using Reg A, and several onto NASDAQ. And it's great to see that this industry has evolved, and there's a lot of new players like DealMaker and some of the others. The old timers in the industry like Keith, who you'll meet in a moment, and myself have tried to merge more modern techniques of capital raising and utilizing capital formation under the new Jobs Act, and trying to integrate that with more traditional Wall Street type methodology. And that convergence has come to light now with what we see with Reg A, to basically allow offerings to occur in a more modern technique, utilizing social media and all the things that John just said, and basically allowing investors to make real-time decisions using real-time information and then receiving that information in a digital manner, but then being able to trade it on to a national securities exchange and actually having liquidity. So it's truly a convergence of both old and new, and really in today's market, giving entrepreneurs and investors the opportunity to get untapped opportunities that they normally wouldn't be able to see, that was really in the past reserved for the Wall Street elite.
And Keith.
Great. Well, thanks, everyone. Thanks for attending. It's a pleasure to be here. Gene, really appreciate you putting this on. Like Mark, I go back quite a ways in the crowdfunding world. The 2012, I remember going to some of those early conferences, super excited about crowdfunding in general. I started Bowstead Securities in 2006 as in part to essentially help underwrite and bank companies looking for capital and give the investing public access to those companies traditionally at earlier stages than they otherwise would, and crowdfunding was a big part of that. We we're a traditional investment bank, so we're involved in all phases of capital markets, including crowdfunding, private placements, but we do a fair amount of underwritten public offerings, taking companies to the NASDAQ and the NYSE. And our prototypical client is a small growth company. And I've learned over the years that they transcend, race, religion, industry, geography, sex, creed, whatever. They come from everywhere. The entrepreneur, has an idea and needs capital to help, build upon that idea. And I learned that firsthand. I'm older, I think, than most everybody here on this panel, going back to the early 80s, when I was part of a small team in Ann Arbor, Michigan, that ultimately took over and created what Activision is today. But I learned the capital markets from the inside along the way, and I learned a couple things: that there is no cheaper source of capital than the U.S. public marketplace, and why not tap into that sooner rather than later? And I have nothing against venture capitalists or private equity firms. I've done my fair amount of private equity investing, but their system's a little bit different. They like to keep private companies private longer and then offload them on the public. And our approach is kind of the opposite of that, where we want to give the public access to these great growth companies at much earlier stages. And so crowdfunding's a big part of that. And in that, we're very collaborative with other firms. We don't have all the investors. No one does. So we're all about, finding the kind of the shortest and most efficient path to raising capital, so companies can go and deploy it and build their business. So we work with a lot of other firms, in that regard on a syndicate basis. And so when Gene reached out to host this panel, I jumped at it because we just want to continue to expand the network and give the investing public access to really great growth companies.
Most people think of a crowdfunded offering as you post your offering on a platform somewhere, and then you advertise and drive traffic to it. And that's been the way that it's been done for a long time. Now, usually brokers have a stable of investors already. And so the purpose of this webinar is to describe how that process would work. And so, Mark, if you could get into how brokers who already have investors that they know, and they know their sweet spot of those investors, how they would be able to bring, how you would be able to bring your investors to a DealMaker where someone has posted their offering on their own website.
Yeah, so it's a little bit different than that. People don't wake up in the morning and want to buy stock. You still have to sell it to them. And the reality is there's so many opportunities that are coming from all these different directions that investors have to make informed decisions and utilize the information that's being presented to them so they can make that decision. And what we saw with Reg A Plus, which was great, was that issuers can now go out onto their own sites and utilize services like DealMaker and other broker dealers that facilitate or host these offerings. But there's no one that's really communicating directly with the investor and being able to bring in the rest of Wall Street, which is important because it's ultimately, in order to see a company listed on a national securities exchange, you need to empower the street to come in as part of the machine or the plumbing in order to facilitate that trading. Because there are things called transfer agents, and there are DTC, and there's market participants, and there's opening bids and offers with NASDAQ and Syndicate and DVP and all these acronyms and words that come in. So what we see here and what we're currently working with DealMaker on, and I know Keith has done this as well 1,000 times with all other types of transactions, is where we work together in concert as a syndicate. And there's a managing broker dealer that gets involved and manages the due diligence process, the valuation process, navigating the SEC, navigating FINRA, navigating NASDAQ or the NYSE, and putting together a book where then there's a deal, basically a book runner that will then manage all the other market participants. So unlike what we see in crowdfunding, where it's on a website, we now see a convergence where we still have the website, but then we also go old school where we have roadshows, where institutions are visited by the broker dealer, where the company is introduced, where broker dealers will introduce to the salesman within the firm, and the company will come in and do a presentation, and then the brokers get on the phone. And if it meets the suitability and meets the investment objectives of the investor, then it's presented to them, and then they can make that informed decision to participate. And then what happens when we get close to closing, and we'll get into the nuances if these questions come up, is basically we merge traditional Wall Street with the crowd in escrow and come together, have a closing, and then the stock opens for trading the very next morning. So it's a win for everybody. It's not buying into a position that you have to wait to see years for it to be able to mature and actually IPO. It's a closing and listing, and really the equivalent of almost like a firm commitment IPO, but done to the crowd.
Now, Keith, you're a managing broker dealer on a lot of offerings, and you're known for your work in doing IPOs. Can you tell us a little bit about what it's like to be a managing broker dealer and what that really means?
Yeah, it's a little bit like quarterbacking the deal. There's a lot of different constituents involved. Obviously, the company seeking capital, its advisors, which its legal counsel, its auditors. We, as a managing broker dealer, typically have our own legal counsel representing us as well. And then it's any number of the selling group members or syndicate members, and of course their network. So the benefit and the objective is to get everybody kind of, I call it, in the boat rowing the same direction, the same speed at the same time, so you can move the boat across the finish line, and the boat being the company's financing. So it's a little bit like quarterbacking all those components, and making sure that the messaging's on point. It's really important that when the syndicate members go out to their networks, they're telling the same story that the company's telling and we're telling. So we spend a lot of time, on that messaging. And of course, in today's world, it's a lot of it's done online and through Zoom. Back in the day, it used to be much more in person, but now it's all done through email and through Zoom. But it's essentially quarterbacking, the deal effort to get it across the finish line.
Now, John,
jump in just
sure.
Because I think one of the things that's important to know when you have a managing broker dealer and you're talking about using Syndicate, the syndicate members can rely on the due diligence of the managing broker dealer, but they still have to do their own diligence. I think one of the things that's different than what we're talking about here in the managing broker dealer is there's underwriting risk, and there's broker dealer liability that's associated with these offerings, where a lot of the crowdfunding portals and the platforms that are doing their own IPOs on their own portals, and they have these broker dealers that basically process their KYC and AML and other aspects, they're really not getting involved in valuation analysis or standing before NASDAQ and being able to opine to the merits of the company. And those are the things that a managing broker dealer and these type of offerings steps up and do. And one of the things that maybe some of the people that are listening in the crowd, they say, well, we're used to paying 1% to these other broker dealers. And that's just not reality. When you do an offering that we're talking about and bringing in Syndicate, the street syndicate typically takes between 4 and 4.25%. And what that means is it's the other broker dealers that come in, the retail brokers and the firms that join. And typically when Keith and I do our regular IPOs, we see anywhere from 10 to 15 syndicate members that participate. And they're used to getting the standard broker dealer compensation. And the managing underwriter then takes the compensation that's above that, which is typically another 3%. Most transactions are about a 7% deal. And that extra 3% is for the banking work and for all of the risk and for all of the assembly of the information and going out to site visits, doing the due diligence, and putting together a package that would then inspire these investors to want to invest, but invest at realistic valuations and realistic hope to see that this company grows.
Now, John, you're known, I've known you personally as a real expert in the marketing of crowdfunded offerings. I've even been jealous of you at times because you're so good at it. Tell me, obviously, this is a hybrid model where you still have to have your marketing expertise at DealMaker along with a broker. So can you tell us how you would do a traditional offering and maybe give us some of your secrets for success?
Oh, certainly. Yeah. Thank you, Gene. And I think it nestles along nicely next to some of Keith and Mark's points there, where, Keith talking about rowing the boat, right? Where we look at digital as one of the rowers. And sometimes that takes, we're one of the bigger rowers, right? In those cases where we're able to propel a campaign digitally. And when we think about syndication, as Mark mentioned, right, it's important to get the street involved. But when we supplement that with digital, right, we can get a lot of additional eyeballs on the campaign. And some of the dynamics of that are such that, while they're able to still raise capital from Wall Street, we're in front of all these Main Street investors, which can be a powerful propellant for a campaign, both in a private offering as well as their Reg A, right? Or excuse me, their IPO, because by the time they go public, not only do they have a following of thousands and thousands of investors as well as onlookers, we've served millions and millions of impressions throughout the United States. So when that company, hits the public markets, people are already familiar with that brand, right? If we think about somebody like Monogram in this process currently, right, in the medtech space, it's almost like the modern day version of Ask Your Doctor, that you see on the TV screen, but, they have an email list, right? And they have people who have already asked, hey, when can we get a procedure, right? So you supplement that with this, groundswell of the Main Street investors, right? And that in tandem with Wall Street can be, a really powerful opportunity as we see these campaigns go out into the public markets. For that, if we think about some of the we'll call them the secret components, right? It's storytelling. I think it was Mark who mentioned it. It's like you need to sell these stories. You got to sell the stock, right? And it's very similar to what we're doing. So the companies who can invest in telling that story digitally, which means website, we go out and shoot a video, right? To do this, to tell their story, to get this pitch, right? To encapsulate that in video and have all of the underlying assets from that we can then, run YouTube ads with or TikTok ads, which sounds crazy, but those things do drive investment, and being able to tell those story in different formats, whether it's a 3-minute video or, a 30-second TikTok, do drive capital in these campaigns as, we are part of the boat that is rowing.
Yeah. Now, Matt, maybe everyone doesn't know what DealMaker does, and what I think you do is really unique in that a lot of people, when they think of crowdfunding, they go post it on a platform somewhere where there's 1,000 other offerings, and you put your offering there, and then you see a flying motorcycle. Oh, well, look at that. And so you get distracted by all the other offerings. And DealMaker allows you to put it on your own website. Can you talk a little bit about that?
Yeah. I want to build on the conversation so far and then come back to that if that's okay,
Sure.
Gene.
Just fine.
Because from what Mark talked about bringing the new and the old, and what John and Keith are talking about, I want to just reflect a little. I think it's important for people to understand the traditional investment banking world, or the world of capital formation, was a set of expertise, highly valuable expertise, involved in bringing an offering to investors and making sure capital formation took place, right? That's like over here. The traditional e-commerce world was about building stories, piercing the noise with a signal, attracting eyeballs and attention, and building engagement and awareness through campaigns, right? And that was considered over here. And I think what the group of us on this panel are saying is, well, actually, these worlds are coming together, right? These worlds are coming together because in the capital formation space, you need the deep expertise of the investment bankers who can get Wall Street's buy-in, but you also have an opportunity to bring in your own community, to bring in the people who, wouldn't have wealth management accounts, who might only want to take, $5,000 on a credit card, who love a company's story and might have been following its product for years, but would never be on the list for an IPO. And it's the bringing together of the two worlds where, DealMaker sees such a paradigm shift and what we think will be a generational change in the capital markets. So I want to kind of lay that out and let people digest that a little bit too. Some of the commentary and some of the and that question you asked, Gene, about DealMaker being different from the portals, you'll never go to dealmaker.tech and you'll never see anything to buy. DealMaker sits in the background to put the issuer front and center, right? Hundreds of thousands of people bought Green Bay Packers shares. They bought them from Green Bay. They didn't go on a platform and select one offering from a bunch. It's the difference between having a store in a shopping mall where customers are milling about and might be attracted to other stores as well versus a standalone store. And our thesis is that if you can tell a successful story in the way John's describing, if you have a track record as a founder, if you can build a community around yourself on Instagram and newsletters, then you can turn that community into a source of capital as well. And that's where DealMaker's real competitive advantage sits at vis-a-vis the portals.
Terrific.
I hope that makes sense.
Yeah, so I often compare going on a platform to a good-looking girl going to a dance. There's a lot of other good-looking girls there. And by going on DealMaker, you're the only good-looking girl there. So can you tell us?
So in a way, it's a way of engaging with the community. If you believe in yourself, right? If you've got a story to tell and you can build a company and you've got a compelling value proposition, then you're not going to share that audience with, people who might be interested in buying multiple offerings. The same way Mark and Keith are going to lead a roadshow and present a company to the most likely people who are a good long-term capital fit. You want to do the same thing on the internet. You don't want to, in my opinion, you don't want to share center stage with a bunch of contestants that are saying, "Well, pick me." You want to identify the prospects or pay the right people to do that for you, Wall Street facing or crowd facing. And then once you've got a thesis around who's a great fit, you go after them with your full force.
Now, Keith, obviously you've got a lot of investors and you've worked with a lot of companies over the years. What kind of company would you bring to an offering like this to put on to share in a syndicated offering with DealMaker? What would be your requirements? If I want to raise capital with you, what kind of company do I have to be?
Yeah, great question. We kind of have 5 criteria. Very broadly, we look at. We start with the team, the company, the people inside the company, and also around the company. Gene, you and I have had these conversations. I know when you introduce us to someone, it means a lot, right? Because you've spent some time typically with these companies or these people, and so you have a basis for the introduction. So, we spend a lot of time with the people because we find that deals are people and people are deals, and at the end of the day, people invest in people. So we start there, and then our typical client is a growth company. So as I noted earlier, they transcend industry for sure, but they all have kind of the same profile, which is they need capital to grow, and they don't have a balance sheet or an asset base that they can go to a bank or attract traditional type of financing. So generally, they're always looking for equity capital, and so we spend a lot of time looking at the industry they play in. Is it a growing industry? And then where does the company fit within the industry? It's product or service, how it fits in. And typically, we look for companies with growth prospects that are growing faster than the industry in which they play. because that's where we find you get multiple expansion essentially. And if you catch it, the proverbial wave at the right time, it can generate a lot of returns, high returns for the investors. The fourth thing we look at is the cap table. And people ask, why the cap table? Because there's a lot of things that can go wrong in a company's cap table along the way. And we're very simpleton in that regard. We like clean cap tables, common, typically only, sometimes preferred. These convertible debt structures with lots of warrants, they can really cause problems when you go out to raise additional capital. And so we typically look for companies with clean capital tables. We generally only issue straight equity in our offerings. And, there's plenty of time for a company to complicate its cap table. We don't think that's something a small growth company should do. And there's been more than one company that's come to us, with trying to raise capital, and we really couldn't unwind what they had done. So that's just something to keep in mind. And the final thing we look at is we look at ourselves in the mirror and do we think we can get this done? And you would think that that would be a natural thing to do, but there's many in our industry who don't. They just sign you up and then kind of let you go at your own pace. And we're the exact opposite. We push pace. We push everybody. We're like a production shop moving inventory across the floor to get it out onto the shelf to be sold. And so we have to feel really confident that we can get the deal done. Otherwise, we just won't take it on. And many times, I passed on many opportunities just because it might have been too early for our investor base. And a lot of these, companies come to us as early stage, but we always like to be introduced to them early because you never know when they will be in a position where we could be helpful, and happy to have those conversations, from the very beginning.
Now, Mark, I've even brought you deals that you turned down because the companies were too early. And so what would be a deal breaker for you? No revenue, just an idea? I mean, what kind of companies that you would think shouldn't try to attempt this?
So, I'm going to add on to a few points of what Keith just said. So our belief is consumer hospitality, entertainment, and med device, something that when you're seeing a convergence between the crowd and traditional brokers are the same thing. You got a 30-second pitch. If you don't understand the story in 30 seconds, there's no way you're going to win them over. And when you take it to the point of doing this on Instagram post or a Facebook ad or anything like that, it's got to be a simple story. And a lot of the deals that come to us they might be the greatest biotech in the world, and that glass of water is going to cure cancer. But the hour it's going to take to explain how it's going to cure cancer, you've already lost it. The first company that we brought public, the very first Reg A to ever trade on the New York Stock Exchange, was a company called Myomo. And I had to walk up and down Wall Street and beg, borrow, and steal every institution, broker dealer, and even the crowd to get to an $8.5 million offering. And the stock, for 6 months, people just laughed at me. And when we got it, and we got it public, and the stock took off, and it demonstrated the power of the crowd. And I think somebody had mentioned that there was actually it's our client, which is Monogram. One of the things that I found pleasure in was that so many people called me after the Myomo offering, and were not excited about the stock, even though it was a triple. They were excited that they finally found a product that they could utilize for their loved ones who had issues with mobility. And we saw that revenue increased substantially for the company. And they were able to use Reg A as not only an opportunity to create shareholder value and to be able to raise capital for themselves, but more importantly, it was able to turn these investors into customers. And then we echoed that the second time when we brought Fatburger public, which people walked in. It was an easy story. You walk into a Fatburger, you know what the burger is. And then they bought Johnny Rockets and they bought Twin Peaks. And the company has now grown into doing, I think this year, over $2 billion in revenue. So we're talking about taking early stage companies, but that are not too early. The everybody needs to think about, if you want to be a listed security, you need to do two things. One, you need to look in the mirror and make sure that you as the CEO really understand what you're embarking on. It's not just taking money. That's the day that your hard work begins. You have a responsibility to the thousands and thousands of shareholders, and to be able to deliver shareholder returns and value to them, and take the capital that they give you and grow it and allow your business to succeed, and in turn create additional revenue and profit for ultimately distributions back to your shareholders. But the other thing is, you have to be realistic. Are you ready for NASDAQ? Coming out onto the NASDAQ stock market, you need to have a certain market cap. It's one thing to be able to generate interest from the crowd, and that gets you started. And it's certainly what we do now. And that's why we're working with DealMaker and others, because the crowd understands the early stage risk and willing to take it. But now when you come to Wall Street, you're now faced with institutional interest, and you're faced with analysts. And if you fall below the threshold, no one's going to care, and no one's going to buy your stock. And ultimately, your volume is going to dry up and your price is going to decrease. So you need to make sure that in terms of what we look for, no less than at least a $50 to $75 million market cap, and not a $50 to $75 million market cap that the CEO believes they have. But when we base it on comps and peers and look at what the rest of the industry is trading at. And that's one of the downsides of Reg A, where you don't have a banker, is that you believe as an entrepreneur your company is worth a lot more. And then suddenly you're faced with the reality that you're in Main Street and on Wall Street, where you're now being compared to everybody else. And if you don't perform and you miss a quarter, you will be penalized. So those are the type of things that we look for. And I want to just echo one thing, because if anybody here is thinking about doing this and they have counsel that has advised them on their first few rounds of structure, fix it now. If you come in utilizing what Keith had mentioned, these complex structures, and we have now had to go through with all of our current clients and file shareholder meetings and proxies to clean up the venture capital paperwork that everybody uses out of Silicon Valley, that doesn't anticipate and understand what Reg A is, because Reg A is not an underwritten transaction. So there's certain types of conversion notices that occur that convert the preferred into a simple cap table of common stock that will enable us to list you onto the market. And if you don't have that, and you've done a few rounds and suddenly you have 48,000 investors, and NASDAQ doesn't recognize the preferred stock and considers it debt, then it's a problem that you can't get listed, and it's a problem that's going to haunt you in the future. So clean, simple cap tables.
Now,
I can't reiterate that enough.
John, Mark said something that I talk to clients about a lot, and that is being able to tell your story quickly. He said 30 seconds. I say 8 seconds. I'll never forget, I pitched a billionaire once, and before his elbows hit the table, he said, "Okay, what do you got for me?" Not hello, not how are you today? What do you got for me? And so obviously when someone is looking at something online, you if it's too complicated, as Mark says, it's going to kill you. So how do you tell the story? Do you have any secrets about that, about how you get the message across very clearly, quickly?
Certainly. Yeah, I like to think of the elbows like the hourglass there. That's a tight timeline to be on, right? But when we think about some of the more successful digital offerings, it's the ability to tell that quickly. And sometimes it's inherent in the company, right, where they have a problem solution that people more readily understand, right? Particularly when we're advertising to Main Street, right? So that is part of the importance of the storytelling, and how do you distill that into a headline and a subheadline, because you're only going to get a few seconds with somebody, maybe a bit more than the billionaire that you mentioned, but you're going to get 7 to 10 seconds of somebody's attention, and you need to display a problem solution that they understand, and ideally a market opportunity where they say, oh, I get this problem, and oh, I can see there being a return on this investment, or this is something I'm very emotionally excited about investing in, right? So, how do you do that? It's trying to distill this company into a problem solution that people can get quickly. And you need to do that with copy and design and video to tell that story quickly and effectively. And then, realize that just as, Keith and Mark, when, you're talking to, different folks on Wall Street, it may not be, this first conversation where the deal all happens. You need to be able to follow up with these investors, right? Which could be, how we plug into the different stages of the funnel and allow somebody to follow up with email campaigns and say, hey, I see that you got here in the funnel, why don't you join this next webinar that we're having, so you can continue to tell this story, and sometimes in a more long form format than, this initial 8 seconds that you got. But you got to set the hook there so you can continue to nurture them and educate them, and excite them about the investment opportunity.
Now, Matt, I've got a question here from a gentleman who says that he is going to be launching on DealMaker in 3 months. And what would be our starting steps to get something like this going? So you got any advice to someone, to a potential client, as to how they can get going with you?
Yeah, I think that's, what do I want to say? Well, there's a lot you can do on DealMaker. DealMaker is a large suite of technology and services, and sometimes we partner with gents on this webinar. Sometimes we handle standalone stuff. So I don't know who you're referring to or what they want to do, but a question of kind of general application for everyone in the group, I think, is, if you look at the ideal collaboration between the people on this call, right? A company that's going to build a community over time and then use that community as one of the group members in a syndicate or a selling group, a collaboration between broker dealers to go and, end up on NASDAQ. Then there's a full end-to-end, right, continuous delivery of value that has to take place. It starts with, some of the things that John have said, having the right story, having a track record, having a value prop that, the public can believe in. It goes all the way through some of what Mark's been saying, right? Being able to perform, being able to sustain targets, being able to persuade not just the crowd, but the street. And then one question that I see in the chat that I'd be interested in hearing folks' perspective on is, when you bring a crowdfunded offering onto a national securities exchange, how do you manage that aftermarket buzz? How do you make sure that there is trading, or is there anything you can do to make sure that there is trading, that the stock price, benefits from that analyst coverage that is part and parcel of the traditional IPO process? Mark or Keith, what do you guys think about that?
Do you want me to take the first stab at it, Keith, and you follow
Yeah, go
up?
ahead, Mark. Go ahead. Yeah.
All right. So that goes back to looking in the mirror, because anytime you decide to be a public company, ultimately the CEO is going to be running two companies. They're going to be running their own business, the day-to-day operations of the widgets that they're making and selling. And then there's the business of running a public company. And basically, you need, as the CEO, to engage a robust IR campaign where you're out constantly communicating to your shareholders, new shareholders, analyst community, and basically institutions and retail, where you're communicating that through press releases. And it's what I call the tail of the tape, where you're building a story of press releases that show that the money that you've raised is being deployed and being utilized to grow your business. And then when your Ks and Qs come out, that it's then reflected in your financial statements. But there are 85,000 stocks that are out there, and it's important that you shine that spotlight on yourself. And that requires a tremendous amount of effort and expense. So when you come public, that's another misconception. People think, we're public now, everybody should buy my stock, they have a chance. You're now competing against every other stock out there, especially in today's market, where we've seen some really quality companies that are trading at a third of their price or down a third, and they're on sale, where we know when the economy gets better and inflation's under control, these stocks are going to rally. So you need to set yourself apart and be able to communicate on a regular basis and show shareholders that you're a great undervalued opportunity.
Yeah, and I guess, I know we said we'd give Keith a chance. Can I sneak in?
Yeah, sure. Go ahead.
I guess the other thing I would have people, when Mark says look in the mirror, right? If you're setting out to build a company, how are you going to sell your product? Well, you're going to identify the value prop. You're going to try to figure out for whom that value prop creates the most value. You're going to try to price fairly and comparatively to other alternatives that buyer might have. Then you're going to have to get in front of those buyers. Then you're going to have to persuade those buyers. Raising capital is the same thing. It's the same thing. It's just sales, right? It's a form of sales. It's a sophisticated form of sales. You need sophisticated expertise, but the fundamental building blocks when you set out to raise capital, if you're in a position to build a company because you can get your product in the hands of the buyers who want to buy it, then you can raise capital.
Great.
Yeah,
Keith, you want to comment on that?
Yeah, just a couple things to add and agree with everything that was just said. I tell our clients they have to what I call play public, meaning you have to play the public part, like Mark mentioned. You have to be out there talking about yourself and your company, whether that's shareholder investor conferences or industry conferences. Obviously having an IR firm to put out traditional press releases, but social media is a big part now, and you can't forget those channels. And there's a lot of noise in the small cap sector, and you as a small company have to rise above it, because I found that the investing public typically finds no news as bad news. So even if the news is not so great, it's still news, and people want to be able to relate to the companies they've invested in, and the only way they can do that is for you to talk about it. And there is a misconception that once you're public, you don't really have to do that, but there's just a lot of competition, as Mark had noted, in this end of the spectrum, and you really need to just play public and talk about yourself and your company all the time to the investing public, every chance you get. And it may not seem like it's significant to you, but it just becomes another talking point.
Well, Keith, how do you keep a deal from being overshopped?
Well, that's a really good question. And it's, we and other firms, we originate a lot of deals. So as an originator, so to speak, because there's other firms that don't, but they have sales staff that want to be able to sell product. We call it product, right?
You could even tell us what overshopped really means.
Yeah, overshop means that there's too many bankers essentially pitching the same deal, and the problem with that taking place is the investors perceive it to be a weak deal, and the investing public there's a lot of overlap. We have investors in our deals that have invested in Mark's deals, for example. And there's just a lot of overlap because not everybody has all the deals, right? So if you're an investor and you want to get in somebody else's deal, you're going to have an account with that firm. So when there's too many firms representing a deal, they can call on some of the same accounts that we might call on. And the investors pick up on that and can perceive an overshot deal as negative or weak. And so that's the last thing you want to have the perception. As a matter of fact, it's the exact opposite. You want it to be scarce. You want people calling you to get in the deal and you telling them, sorry, it's oversubscribed and there's just no room. Mm-hmm. And so part of that is working with those that have a complementary distribution base where there's not a lot of overlap. And over the years, we've been able to ascertain, who some of those firms are, and also to try and keep, investors in the deals. And we say, well, why? That seems like common sense, but there's a lot of accounts out there that will just come into a deal to flip out of it, and that's what we try not to have happen.
Keith, I'm going to just expand on that just real quick because that's actually we didn't even touch upon that. So when we do our Reg A's now, and when we work with companies like DealMaker and the Syndicate, we get really excited about having the crowd involved because the crowd truly are loyal investors that believe in the product, believe in the future, and want to support the issuer and the company. Where there's a balance with Wall Street, where Syndicate, there are certain investors that absolutely have that same mantra, but there are others, and the term is an IPO whore, where they come in and they're basically going to sell back the stock on day one and they flip it. And a lot of the brokers, and this is something that I think, the dirty little secret of Wall Street, is that there's no commissions that are paid by investors on IPOs or these type of offerings. It's the issuer that's paying the commission. So the broker makes his money, and the broker makes his commission month by selling those shares because he makes the commission on the exit. So many times when we see stocks rise after the IPO, the broker has no allegiance to the issuer, and they sell the stock, they make their client money, and they move on to the next one. So it's an important balance to make sure that you have the right players that come in and not allow those type of, and again, the term in our market is the DVP players, participate, because they're just going to hurt the deal.
Mm-hmm. I'd like to throw this out to everyone. Obviously, this sounds terrific. So where are the problems? What are the things that you see that can mess this up, or people that mess it up, or things that might mess it up, or rules, SEC rules that might mess it up? What do you see as any problems with this? It sounds like a great thing. Brokers bring in extra investors to an online deal. What's wrong with that? Can you tell me any problems that you could foresee?
Well, I think the biggest problem I see is just what I explained, where sometimes the unfair advantage goes to the street versus the individual investor, where they get the benefit because they know how to professionally trade, where the crowd, it takes a few days for the positions to get into the market, to get into their E-Trade or Schwab or Robinhood accounts, where Wall Street has the shares day one the minute they open. So there is that balance. We're working right now with DealMaker on, I think, Matt, I would say that this is the first deal that I've ever been involved with where we really see convergence, because we have two other crowdfunding platforms, very well-known names. I'm not going to say their names because they're not here today. And DealMaker and our firm and Street Syndicate. It's exactly what you're looking to do. The company's currently testing the water, so we can talk about it. It's called Monogram Orthopedics. But this will be a great test because it's a serial Reg A issuer and a Reg CF issuer with DealMaker, and they've grown their business, and now they're at the point to go into the big leagues and finally attract the institutional Wall Street interest. So it will be a good case study, I think.
Great. So
I'm really excited about that one too. Keith, I didn't mean to cut across you. I think you're about to say something as well.
Go ahead, Matt. Yeah.
There's so much, does everybody remember the headlines around Wall Street bets and GameStop and the tens of thousands of individual investors who want to get into some of these offerings, right? Who have a company they believe in. And, Mark, you talked about it a little with your client, with the purchaser who understood the product and wanted the benefits of that product being in the market from a health perspective. I think Monogram's another great example. There's so many companies out there that are doing something that people really believe in. Remember when I separated out, Wall Street investment banking, finding capital for the company versus finding customers for the company. And there's such a big opportunity to give people a chance to participate in a story they really believe in, that, I think we have to make sure, we as capital markets participants, make sure that demand is harnessed responsibly, right? We all do significant due diligence. When a company comes on our platform, or when a broker dealer accepts new business, we look for what we're supposed to look for. A broker dealer bringing an offering to the public is making a statement, right? That they're affiliated with that company. And so we all need to be responsible. And I think, across the industry so far, we've seen pretty good track records of companies coming to market. But, is there an Enron out there that's going to lie? and defraud the SEC and investors? And, will members of the public possibly get caught up in that? Nobody knows the future. Nobody has a crystal ball, but it happens in the public markets. It's going to happen in the private markets too. So I do think people, get very excited about these stories and they're still making investment decisions, right? They're spending money and they need to do that carefully.
Do you think that it's pretty much a requirement that in a syndicated offering to get everybody excited that there's going to be a listing at some point? Anybody?
Yeah, I mean, I think investors, want to know what their exit ultimately is. So obviously, a listing is one way to accomplish that. A company being acquired, either for cash or public company stock through an acquisition is another way. So I think that's important. That's part of the company's capital markets plan. Ultimately, is what what is the exit plan for the investor? Because the worst thing that you can be is a minority investor in a private company. You really have very, very little rights, right? And so you're kind of beholden. I became a product of the capital markets in the 80s when small companies went. It was actually the norm. It was, I give the example, Nike went public in 83 with a $50 million market cap. When Microsoft went public, it was a $350 million market cap. When Activision uplisted to NASDAQ in 92, it was a $25 million market cap. And Activision got sold to Microsoft for $78 billion last year. So you calculate those returns are off the charts, right? But it's now started to come back. And what I mean by that, kind of after the .com era, small companies going public went away. And part of it was regulatory, but part of it was private equity and venture capitals realizing they could keep these companies private longer and, garner much more of the returns. And the example I give is Rivian, which, I never got an opportunity to invest in that company until it went public in December at essentially an $80 billion market cap. And today I think it's $17 billion. So had you invested in that when it went public, you're down 75%. But I can tell you Ford and Amazon, when they got the call to make the private company investment, they invested at much lower values and did extremely well when the company went public. It's to me, it's a great, even though markets are very difficult, it's a great time to be a small company seeking capital because the crowdfunding in part has helped open some doors that otherwise weren't available to companies. And now the NASDAQ in particular, the NYSE a little less so, they're very receptive to small companies listing on their exchanges. And for us, we big proponents of that because like I mentioned earlier, the cheapest source of capital and in my mind is the U.S. public marketplace. And as a growth company, your most expensive cost is your cost of capital because you need to keep raising it. So, so that's what we try and do. Gene, I just wanted to come back to one other thing, about what can go wrong. You create something of a wealth effect when you raise capital for companies. And, the hope is that the company will use the capital you've raised in a good way, be good stewards of that capital and deploy it, effectively and efficiently and generate a return. But I can't tell you the number of times where, when an entrepreneur or businessman or businesswoman, have new capital, how they ultimately start changing how they deploy it. And
get that Ferrari. You got to have a Ferrari.
Yeah.
Right?
Yeah. So I had a good friend that said to me a long time ago that you never know a person until you try and split an inheritance. And when you raise capital for people that pulls a lot of people out of the woodwork who you didn't even know existed. But generally,
well,
yeah.
We've got 4 minutes now, And what they say, and as John will tell you in marketing, is always have a call to action at the end of whatever your pitch is, right? And so the call to action here should be everybody tell what your website is. If they want to know more, they can send an email somewhere or go to a website. So John, you and Matt want to go first and tell people where they can find out more about DealMaker.
Yeah, certainly. And thanks for hosting. This was a lively discussion. There's a lot of questions there in the thread. And if we didn't get to you, we'll compile these and get back to you. There's also a recording of this. But for DealMaker, come sign up for a demo. We can show you all about it at dealmaker.tech.
Okay, and Mark?
For us, we're at digitaloffering.com. So happy to look at your opportunity and would love to work with you.
Okay, Keith?
Yeah, Bousted, 1828.com. People ask why the 1828. We named the firm after Edward Bousted, who was the first merchant trader to establish a trading route between the UK and Singapore in 1828. And so we adopted his pioneering spirit, and that's why it's Bousted1828.com.
Great. It's mediashares.com for me. I'm Gene Massey, and we want to thank everyone for coming today. This is a very wonderful discussion on a new model for capital raising, and there will be a recording if you registered for this, and you can forward it to your friends. And I'm sure everyone here would love to hear from you on their websites. And any closing comments, Matt?
I think the message to the world is tell your friends, right? If you can build a community, you can turn that community into a source of capital. And the application of e-commerce principles to the raising of the capital extends also to the listing of an offering in a national securities exchange. So I think it's really, really exciting for all the companies out there that are going to be publicly listed or want to be publicly listed. And I can't tell you how many times when I was practicing law, and I'm sure Mark and Keith will say the same, you bring an IPO to market and people want to get in. They might want to put in $5,000 or $10,000. They might be, an employee, a customer, and they can't get in because they're not, they don't have wealth management accounts with the banks that are participating in the offering. And so with the group on this call, we can bring that change into the capital markets. We can let a company bring its own community into the capital markets. And I think it's really exciting.